So in today's video, we're going to talk a little bit about selling your principal home or selling your investment property and what kind of taxes you're going to pay to the government on these dispositions. So if you were selling your principal home, and let's just say you've lived in your principal home for 10 years, you've bought it for $500,000 and it is now $1 million and you're selling it, well, guess what? In Canada, this is the best investment vehicle. There are no taxes paid on the gains, on the profit of this sale. So if you bought for $500,000 and sold for $1 million, all $500,000 go into your pocket. Great investment, great tax deferral basis. Okay. Now let's talk about an investment property. If you were holding on to an investment property, and let's just say again, you bought it for $500,000 and you are selling it for $1 million. Okay, there's $500,000 of profit, if you want to say, in this property. Now, in dealing with an investment property, there is the capital gains exemption that applies. Okay, so in Canada, what they do is they take your total purchase price, and which is determined as your cost. Okay, so your purchase price in this example was $500,000. Let's add on land transfer tax because you're allowed to build that into your adjusted cost base. You get to put in your legal fees at the time of purchase and any capital costs. These are renovations, additions, improvements that you did to the property throughout the 5 or 10 years of ownership on this property. So again, using this example, let's assume you purchased for $500,000. All of your renovations, land transfer, legal fees, let's say was $100,000 for simplicity. So now your adjusted cost base is $600,000. Okay, your net proceeds, this is the amount you put into your pot. Your net proceeds equals your selling price minus your adjusted cost base. Okay, so in this example, you've sold for $1 million. Your adjusted cost base is $600,000. So your net proceeds are $400,000. Now, in Canada, like I said, you've got a 50% capital gains exemption. So assuming your net proceeds are $400,000, 50% of that is applied. Okay, so now you're down to $200,000, and $200,000 will be the proceeds, will be what your taxes owed are based on. Okay, so if you are in a marginal tax rate of, say, 30%, 30% of the $200,000 is $60,000 of tax that you owe the government. If you are in a 50% tax rate, you will owe 50% of the $200,000, which is $100,000. Okay, so that's still not that bad considering you've made $400,000 on this property and you're going to pay taxes accordingly. Hope you got something out of this.